I request.
Good morning, everyone. Myself, Subbarao. Today we are starting. This is a new session for us. This is a new financial year, and we have ended 2022-23 with lot of sessions, especially discussing in valuations, in Companies Act, in DCF, in other models. And this is the first session for us for this financial year. And also, I welcome all new members for this Bangalore Value Association. And also, I request if anyone missing for renewing for the new financial year, please renew it. And also, I welcome today's speaker, Vishesh Unni. And also, I request Shilpa to give a brief introduction about Vishesh Unni and start the session.
Thank you, Subbarao. Good morning, everyone. I would like to make a few announcements before proceeding to introduce today's speaker. May 13th, that is next month, second Saturday, we are planning a full day physical session at Bangalore. We are having initial, financial modeling session. Second session will be cap table, and post lunch it will be a panel discussion on intangibles, followed with a case study. So I request all the participants to please block your calendar. Official announcements will be made shortly, but this is just a intimation to all of you. Yes, it's my privilege today to introduce today's speaker, Mr. Vishesh Unni. He's a partner at ARCO, handling mergers, acquisitions, valuations, fraud investigations, and due diligence. He has over 8 years of experience in practice, consulting, and teaching. He's a CA, CMA, CGMA, ACFE, and RV. And his qualifications, yes, my God, many certifications he has done in addition to the qualifications what I have just now said. Few of them are a certificate on anti-money laundering from ICI, certificate on forensic accounting and fraud detection from ICI. And he has done a lot of, valuations, audit and assurance services, consulting and due diligence and forensic audits. Over to you, Mr. Vishesh Unni.
Thank you, ma'am. Good morning, everyone. It's a pleasure to be here on the Saturday morning at this Bangalore Values Association. I think ma'am's given a quick introduction to me. All those certificates are every year I do a CA Institute certificate. So that's why it looks big. Nothing else. For CP hours, I end up doing a certificate course rather than attending various events because it's faster. That's why it looks, it's this thing, it's nothing much. But yeah, so today I'm going to be talking about a specific merger. This is with regard to a specific merger which I had to handle. This was for 13 companies. Finally, what happened was for 13 companies in Kerala. I will be sharing the order also with all of you. But before getting into the specifics about that particular merger, there are, I will talk about the challenges which we faced while we encountered. Probably I'll share. I'll be a bit more candid about sharing the reactions I had when I first saw what entailed. And there is a particular diagram which I will show you all, which we sort of had to untangle, right, in terms of the corporate structure which was created. So at the outset, this is not uncommon, right? Like whatever we are going to discuss today, this is pretty common with a lot of family concerns and groups in India, right? Not just in India, in a lot of other countries as well, which are less so in organized economies, say like the US or in Europe, where there are a lot of restrictions on capital structure, but more so in countries like India and other developing economies, and obviously, elsewhere as well. Even in Korea, people have seen this with Samsung and Hyundai and all of these things. So this is nothing new in terms of what was there. The challenge being that unlike in, say, the case of a Samsung or a Hyundai, where they were all public companies and they were, there was a lot of tension and there were other minority shareholders, etc. Here, the situation was very different. Like in most family concerns in India, where ultimately, if you see, it is controlled by a few specific individuals, right? Depending on the group, depending on the size, it can be one person or two people or a family, right? Usually, that's how control works. In fact, I think recently, even one of the big listed entities, groups. We have been looking at the hierarchy put out and discussed in public, talking about how one or two people actually own all the companies directly or indirectly, even though they are listed entities. Pretty well-known or documented issues which are there. So the idea which we have, the idea today is to just give an introduction into what entails in solving this. Obviously, the solution I used in this particular case cannot be used for other cases without studying whether it is applicable or not. Right? Each valuation is unique. There is no one size fits all. I think we are all aware, right, in terms of the purpose of the valuation, the basis of the valuation, the premise of the valuation, and the other requirements around it, right? So, as such, with mergers in India, I think many of you will already know, but for the benefit of people who might not know, I think in terms of legal precedents, right, whether it's the Mafatlal case or the Unilever case or whatever rulings have come subsequently, as far as mergers are concerned, the general way the courts look at it is to look at commercial wisdom, that a particular scheme is arrived at and there are two sets of shareholders and obviously there's a creditors meeting, etc. And they use their commercial wisdom to allow the merger to go through, right? As in they are, it's a group of, ultimately a company is controlled by a group of shareholders. And if the shareholders in their wisdom feel that something is best for them, then there is not much application for the court in terms of what needs to be done or to question it unless in terms of they feel that the merger is to defraud somebody or it is against public interest, right? So these are the areas which usually are where a merger doesn't go through. So I mean, for academic purposes, you can search. You will find there are a few. We looked up a few cases also that I haven't included that research here because that was done by the secretarial team who handled it. Where we looked at specifically in terms of what are the ruling where things went wrong when people tried to merge so many companies, right? 13 companies is actually quite a bit in terms of uh, what to say, in terms of number of companies, it looks big, but as such, to be honest, majority the issue was really in terms of shareholding and not in terms of the assets or what was there for valuation. The real issue was around figuring out how to untangle the loops and chains in mergers, right? Like basically, there were enough and more situations where uh, things were it looked on the outset when we started. I will show you the diagram finally, and you will understand that it looked very complicated. So then we knew that immediately the solution, whatever has been used elsewhere, could not be used because ultimately we need to have a scheme which is understood by everybody, right? Like there is no point in getting into complex mathematical modeling, etc. When ultimately, if another person has to vet it, understand it, it cannot be something very complicated. Unless the situation demands it, it's not necessary to complicate it. So that's why ultimately what we chose to do was to keep things simple and work with the promoters also making them understand what can be done. So before I get into the details, to the specific case, I would just like to give a introduction in terms of what are these loops and chains I'm talking about, right? And what would be the challenges. Now, as far as chain holdings are concerned, this is a scenario where A is holding in B and C, B holds in D and E, C holds in F, etc. So this is something which is very common day to day. All of us valuers encounter this, and we are all very comfortable valuing this, right? Over a period of time, we know that every asset in the chain has to be valued, whether for Companies Act purposes or for income tax purposes, whatever purposes we are doing it. Every asset owned by the company has to be considered. So if there are other, basically in A's balance sheet, B would be an investment, in B's balance sheet, D and E would be an investment, etc. So in all these cases, we know that each and every company has to be valued individually uh, based on the business of the company, based on where they are coming from, uh, based on the premise and basis of valuation. The method would be chosen and we would value it, and we would, to let's say, to arrive at the value of uh, B, say of A, we would end up adding all the valuations and we'll finally have the value of A. This is something which is pretty straightforward. And I think now this is very settled in terms of what we need to do, right? We usually have this sort of a structure with a lot of corporates, with a lot of companies, whether in India, whether it's going to be a local subsidiary, whether a foreign subsidiary or local investments, whatever may be the case, right? So there are also cases where, for example, if you are investing, valuing a fund, let's say an investment fund, there are cases where they would have done in 5, 6 companies they would have invested, and each of those companies in turn would have other subsidiaries, and then in turn have other investments, etc. Right? So to finally arrive at say a fund value, we would have to end up valuing every single asset in the entire value chain and then rolling it back to arrive at the value of the fund. So these sort of scenarios are something which we have encountered day to day. And even income tax as per 11 UA says that if you're any unquoted equity shares held by a company has to be valued as per the same rule, which is nothing but either the net asset method or the DCF method, whichever is appropriate, right? So this is something we are all comfortable handling and we are all familiar with all. But the difference comes with this particular thing, right? So we are talking about loop holding or cross holding or whatever you want to call it. So I call it a loop holding because this is a scenario where A holds in B, B holds in C, C holds in D, D holds in E, and E holds in A. So how do you resolve this issue, right? So this is a case where if there are two companies, we know that there is cross holding. We use an simultaneous equation, algebra equation, and we solve it. If there are three companies, we can go for a quadratic equation. Again, slightly more difficult, but it is still possible for us to mathematically solve it. But what happens when there are more than three companies, right? And that is where I think most of us would be left perplexed. I think we have all encountered, some of you might have encountered this scenario where you're left wondering how to value this, right? All this sounds nice. We know what is it we want to do, but how do we value this or how do we assign value to these individual companies, right? Because ultimately, it's not just about say valuing something. It's also we have to give a swap ratio. We have to figure out which company is going to absorb the others. We have to give a swap ratio. We have to look at what is going to be the cancellation of share capital. What is the ultimate number of shares to be issued? So there are a lot of other procedural issues also which have to be dealt with. So it is not just that I mean, it's pretty much what happened, right? So I very happily gave the valuation, etc. And then the company secretary just asked me, but how many shares should I issue? To tell me exactly how many shares I should issue, I will issue it because I don't understand. Like I understood, but I'm not going to say I understood everything. So you just tell me how many shares have to be issued, right? So then I had to again, but it was good because then I had to sit and reconcile everything again and tell them that listen, these are the number of shares to be issued, right? And that is actually the biggest fear because yes, now we have got the scheme approved, but beyond having a scheme approved, it has to be implemented. So tomorrow, if we are going to have any issues in implementation or issuing the shares, then the entire process is wasted, right? We cannot. It is also going to be highly embarrassing for a lot of people that after doing so much of work, something is going to not go through, right? So we are. While preparing itself, we have sort of looked at what are the shares to be issued, what are the entries to be passed, how much share capital are we going to be cancelling, all of those things we already actually looked at. So whenever a merger assignment comes, this is actually the challenge as a valuer, right? Let's be honest. There are times, yes, where we clients call us and they tell us you give a valuation, everything is pretty much done. The transaction pricing has been done. We are seen as just a chapa, right? We become basically president of India, not a governor, but president certainly, where we just put a chapa, right? Where we just do some calculation and say, yes, everything looks fine, right? Some lot of people seem to reduce us to that at times. But when it comes to say mergers or demergers, there's a bigger role to be played, right? And irrespective of who are the consultants in the merger, right? Because I have done a case, there are cases where I have handled with the big four. There are cases I've handled with some bigger consulting companies, etc. Common sense test is something which we have to bring to the table, right? Because ultimately we need to look at the rules, we need to look at how things can be valued, and there are certain basic tests which we need to have, right? So in a merger or any of these things, we have to look at what is the income. First thing, as much as your basis and premise, you can choose as something with a let's say participant specific interest or an equitable interest or whatever may be the case, and accordingly you choose book value or DCF or market value, whatever you're comfortable with. Uh, Ultimately, there comes an issue of public interest. So, what are the minority shareholders going to do? Right? So you'll have to have a minority shareholder consideration in all these cases to see how, if you were a minority, how would you react to this merger? Would there a challenge be mounted by a minority to say that this is against my interest, I don't want this, right? So usually when it goes for litigation, you're aware of the rule 10% or more uh, to go under operation and mismanagement, which is where they would usually take this if they are going to challenge it. Yes, there are enough rulings to say that you cannot be a very small minority and just keep challenging it to harass the company. But invariably, there can be a challenge, and it will come down to a question of valuation as well, right? So we need to consider that. We also need to consider Income Tax Act, right? To me, usually Income Tax Act is something which is primarily very, very important. Ultimately, right? Let's all be very, very honest. All mergers and demergers are almost all mergers and demergers are tax planning exercises, right? Whether we like it or not, that is the truth of it, right? So why do companies merge and not sell it to each other? If this whole running around hoops for 1 year or 2 years or whatever, jumping through hoops, doing all of these things wouldn't be there if this was if there was no legal restriction or if there was no taxation impact, then people would very happily transfer the assets without anything, right? They can do a slump sale. It's very easy. You do a business transfer agreement and you can transfer things, or you just sell things outright. All of these options are available, right? But considering the income tax impact, considering that we would have to pay a tax on all of this, and also considering the GST impact on all, if you were to directly sell or do a BTA, etc., then it would be that's why people come for a merger, right, or a demerger, because they know that we need to go through all of this to save the tax. Ultimately, it comes down to cost versus benefit analysis, and it anyway there is a registration to be done. If you're having any properties, there is a change in registration to be done. If you're holding any trademarks and patents, there is a change in assignment to be done. All of these things remain, right? So based all of these things remain in terms of other compliances, but ultimately, you call for a meeting of creditors, you notices are sent to income tax, to PF, etc., and then specific to the creditors as well. Apart from that, to any other specific government agency which is involved, and you get a clearance from all of them. The regional director has to clear it. The liquidator appoints a chartered accountant who goes through, who does an audit of all the things and says, okay, everything is fine, right? There are each of these points is also a cost. It's not just that each of these things is a compliance burden; it's also a cost. Ultimately, we jump through all these hoops. Sorry.
Can I have one doubts or at the end?
Yeah. Yes, please. Yes, please.
No, you are saying that this is a tax planning exercise, and the second thing is
Yes.
when a notice is sent to all the departments, including income tax department, RT. What are the probable objectives from income tax and RT and other? Just any idea?
Yeah. Usually, yes. As far as income tax is concerned, usually it is about any demands which are there. So there's a specific section in income tax where the department can block or undo transactions, right? So that's why a notice is sent to get their no objection if they feel the scheme is going to alienate the assets, right? Let's say there is an attachment, right? So if the attachment is not disclosed, so the department has to see if there is an attachment. There is a case where somebody has come to me for a demerger where there is an attachment and they want to demerge. So you can't do it because the notice will be sent to income tax department and they will say, sorry, this is attached. We can't do it. Right. So as far as RT is concerned, again, if any of the secretarial compliances are there, right, they will go through it. And again, if they feel that this is being used as a vehicle to defraud somebody, then they can raise objections. Right. As far as income tax is concerned, they will be they would reply properly, looking at what are the notices, etc. If they reply, they will look at all the notices, etc., and tell you, yes, there are issues. You cannot do it. Because usually there will be some notices outstanding, right? Like there'll be some assessment order, something pending, etc. But routine things, they will not stop it. But say, let's say the companies had issues with search and seizure, or there has been some other specific issues, large tax amount outstanding, and all of those things, then they might object, saying that, to reserve their interest, saying that, sorry, we have to recover these amounts. So then they will not allow the merger.
Yeah.
But usually,
Sir,
most cases, they allow. Yes.
Vishesh, to add your point, okay, Chandrasekhar, see here, the statutory authorities, okay, depend to case, they will ask, okay, because even we have seen in one case, in one state, the ROC has become the official liquidator, and he is going through, and the official liquidator is going through the CSR activities and the other proceedings like minutes, ROC. Then we requested again, OL, sir, this is not your, okay, this is RD, ROC will do it because he is having experience in the ROC, the OL is saying here. It's all depending the authorities, okay? Then the knowledge and everything, they will see that. We
Exactly. My
cannot
second
predict,
question,
okay?
yeah, Venkat. So
Okay.
my follow-up question is same thing only. In our case, where RD, ROC, OL, income tax, they sought information. I agree, income tax is okay, but now surprisingly, OL office also they're looking after all secretary compliance and majority of the CSR, including valuation. And also now there is a notice from the RD office asking all secretarial information plus valuation report and also fair value of assets and liabilities, accounting, how it is done. So I'm a little like wonder this what they will understand suppose if we share information. So whether is it the domain or just they're asking. And I thought just
Sir,
looking for one
to
thing.
answer this question, I told ma'am also, Shilpa ma'am also, that we'll stop the recording after some time, and then we'll have certain discussions.
Sure,
So probably then I can take it.
Sure.
Right. It is one of those questions which, to be honest, we are in India. There is a system where people want to ask a lot of. When an officer is asking a lot of questions, what is it where there are two places. Either he's a very knowledgeable, honest person, or there is something else. Right. So, I mean, I can tell you I think you will understand what I'm telling. So
Yeah,
most
I
often
got
than
it.
not, that's what is happening in mergers. Right.
I
It's
got it, sir.
nothing else. They are asking you for all of that. That is the reason why they're asking. It is nothing else. Right. So to ensure you turn up, that's all. Only if a person comes can they ask. That's the thing. Right. Okay. There's a question in chat. After clearance is done, is there a search and business premises? Can merger be stopped? See, usually if it all depends on hearing. So if income tax sends a communication saying, okay, go ahead. But before the hearing in the tribunal, they do a search and they find something, they can stop it. Obviously, they can stop it. Right. So it is a question of usually, again, if they again send a notice stating that no, it has to be stopped, then obviously the judge has to say, okay, income tax is pending, stop. So, yeah. Okay. So moving on. So this is the sort of scenario usually. I mean, I was talking about how most of the mergers M&A are tax planning exercises. So in this sort of scenario, let me talk about a specific challenge. Right? Okay, this is usually this sort of setup is usually held in yes.
It's okay. Screen is moving now. I thought screen is screen is moving now.
Yeah, sure. Okay. So this sort of setup is usually held in close groups, right? Where a single family or an individual ultimately controls a company. There are cases where, for example, I have a client who has 90 companies. This is a case of 25 companies, but I have a client who has 90 companies. And to be honest, all the companies usually have completely different setup with different auditors, etc. So to look at it, this is each time a new line of business is done, each time something new is started, you will have a very different perspective on they have a different perspective. Say, okay, we need to have some minority shareholders, we need to have certain compliances, so we will start this. Now, generally, what is understood is there's a very well advertised company now, group of companies now in public domain, listed entities, where you can pretty much see, right? They've bought cement companies, they've bought various other assets, they've been buying ports like how you and I will buy chocolate, right? That's the way things are happening with a particular group. But ultimately, if you were to go down, you really don't know who's in control, right? Being more resourceful, they are obviously used foreign entities also to mask the ultimate control, right? So today, if anybody asks who is the person who's controlling those companies, I don't think you or I have an answer, right? I don't think the authorities have an answer, right? Though there is a lot of ultimately the person outside the country who is able to do a neutral research has indicated that yes, there are a lot of issues which have to be looked at, and they have questioned what has been happening. But I think for whatever reasons, right, which I don't want to get into, people are not uh, the authorities are also not going in fully, and they have to find out now who is the ultimate owner of these entities, whether non-compliances are there, and what is the impact of those things, right? So this sort of a methodology is used where all these chains, crosses, and loops, and all of these sort of holding are done to make it very unclear and confusing for all the authorities, especially there. So I would break it down into three things. uh, Compliance planning. So I didn't want to call it just tax planning because it's for other compliances also, right? So it could be that who could be a shareholder, or the minimum threshold for a listed entity, all of these things. If it is something legal, then we call it planning, right? I'm legally allowed to do something, uh, then we call it the planning. That is the good side of it. uh, I am only trying to avoid certain compliances, right? I know I'm supposed to have been doing certain compliances, but i am I'm a genuine person doing genuine business, right? My intent in terms of doing business is not wrong, but I am trying to just avoid certain compliances. Now, obviously, avoidance of compliance is also wrong, and it is against the law, but that is still okay. That is still bad. It is not the ugly. The ugly is when these sort of structures are specifically created to defraud people, right? Like defraud the larger public, defraud others involved, etc. Right? So we see cases of these sort of structures are used for all three. Uh, you know, I'm going to say all my clients are in one compliance planning, because I guess that's the way to look at it, right? Whenever we, as a valuer, we also need to have a slightly more positive mindset where we think that things are happening for the good. But obviously, jokes aside, uh, we have to, as valuers, we need to look at whether the bad and the ugly are there. And if we are going to be valuing any company, not just for a case of merger, I'm talking about outside of a merger, somebody comes to you for a valuation and you see very complex corporate structures. You need to be very careful in evaluating whether the bad and the ugly are there. Tomorrow, whenever there is the bad and the ugly, there will be at some point they are going to get caught, right? uh, it's just not that at some point the truth will come out, and whichever point it comes out, we shouldn't be dragged. So we are not involved in any of the day-to-day operations. We are not involved in any of the other things. We interact with the management limited to certain specific questions and issues, right? If we are doing a net asset, then we take the signed balance sheet, audited balance sheet, from the as signed by the auditors of the company. And a lot of times, simple things like title of the assets, we assume it is true, right? So there is some land and building. We understand that the land and building title has been verified by the auditor. Whether they have done that or not is not our concern. But uh, if you feel something is wrong, don't hesitate to ask for more information, right? Uh, there's recently a very good case where, again, a very dense corporate structure, right? They came to me for evaluation where they want to, it's for purpose of FEMA. So they had to look at, they wanted to sort of do a buyback. So when I was going through the issues, I knew that the corporate structure, looking at it, I wasn't comfortable with the corporate structure and also the transaction which was happening. So they wanted to make certain provisions and do certain other things. I was very clear about one thing, that this is not my job. I'm not your auditor. Please tell your auditor, which is a very highly reputable firm, you please tell them to do a limited review and tell the audit firm to sign. So once the audit firm is, the management prepares the financials uh, and the notes to accounts, the auditor reviews the financials and notes to accounts and does a limited review and says, yes, I have not done an audit to see whether this is right, wrong, etc., but gives me a LR, right? So based on an LR, if there are certain transactions which are coming in, then we can be more comfortable, right? So the idea is that I don't need to go running behind to see if, let's say, the debtors of the company have suddenly increased overnight, right? But from the last audited financial statements to the current date, the debtors of the company have increased tremendously. You don't have a comfort, right? So is there a corresponding increase in sales? Yes, there seems to be an increase in sales, but let's say the sales is with related parties. So do you want to take on the liability of having analyzed this, considering the change in circumstances? Because if you look at what are what the MCA rules say, we are expected to do due diligence. Even the valuation standards talk about it. We are expected to do a due diligence, and there is no degree of due diligence mentioned anywhere, right? So it is one of those things which is to be tested in the courts of law and in terms of disciplinary hearings, etc., or reviews to be done. But I don't think any of us today know what is this appropriate due diligence to be done, right? So it depends on case to case basis for us. So without knowing this threshold, if you are uncomfortable, tell the company to do a limited review, right? So usually companies have very good relationship with their auditors, right? And the auditors would be ready to review and sign. If the auditors are not ready to sign an LR, that itself is a big red flag for us, and we cannot take up the valuation, right? So in the case of mergers, usually what we need to look out for is, again, it's simple, right? If you're, I'm coming from an advisory perspective where I talk to the client, I understand their structure, we look at a step-by-step restructuring, and then we give the solution. So in these sort of cases, we look at whatever basic questions on income tax, whether all the compliances are there, any other issues are there with any other authorities, who can come and raise an issue, right? Is there any labor issues which are there, which suddenly the union can go and say all this is being done. It's not a question of whether we will ultimately win the case. It's not about fighting. It's always about trying to minimize the timeline and the cost, right? If the company is very clear, we know the difference. A promoter is coming saying that, listen, I don't care how much this costs. I want to do this. There are people who are being disruptive and I want to get rid of them, right? So those sort of cases, there's nothing you and I can do. We'll obviously we are going to have to deal with that scenario. We need to be careful in terms of the value we give, because the value will be contested. But other than that, there's nothing much else we can do. But in most other cases, it is better to evaluate what are the issues which will prop up during the merger and see what is the recourse we can take and whether the merger will go through or not. So I was talking about a demerger where the property is attached. So I pretty much told them, sorry, this is not going to work, right? So for again, another big example for demergers is if suddenly everyone realizes that I can do a demerger. So you need to identify two divisions of business. So if you don't have identifiable divisions of business, right, you're not able to justify it with in terms of turnover or assets or something, then there is no question of two divisions of business, right? And another thing is people think that they can use demerger as something to avoid income tax by transferring the properties. Please read Income Tax Act. It says the demerger has to be done as a going concern, right? The demerged entity should also be a going concern. Only then it will be considered as a valid demerger under Income Tax Act, right? So these sort of things, and so if somebody says I'm having a lot of properties, I'm going to demerge it, and then ultimately I will sell it from, I will induct some shareholder there, and then sort of transfer it, etc. All that planning has to be studied very carefully, and with your GAR coming in, things are going to be even more difficult, because GAR says that just because something is being done in a particular manner, it doesn't mean that or tax planning was incidental and not the main objective. Because nowhere in any of the merger schemes will we talk about tax planning being our major objective. It is always incidental, right? So despite this being a court process, despite this being so many other things, we don't know how GAR is going to be applied, right? If GAR is, we would have to, I don't know who's going to be the first one to be tested, but some merger will be tested soon, right? Somewhere, some transactions will be tested. Once the test, depending on where it goes, which tribunal it goes, which high court it goes, we will know what is going to be the thought process behind it and what sort of ruling we are going to get, and then ultimately going to if it will go to the Supreme Court, what which judge is there at that point and what is their view on the entire thing and what they're going to say. Hopefully we have somebody very good who has got a tax background and who understands all of these things and is there. Else we could have entirely confusing things happening, like we have had a lot of recent judgments, right? So this was the general background on why people do the things and what are the issues we face because of this. Now, one of the reasons why people want to resolve these issues today is that, one, how do you, if you want to move shares, right? So I'm having a loop holding. My primary concern becomes, let's say I am a shareholder in company A. Now I want to transfer my shares. With income tax, it's very difficult to figure out, right, how to transfer it, right? Like, how do I value it under 50 CA? So 50 CA is a section which sets the minimum floor price for us to transfer the shares. So revenue A read with 50 CA, rule revenue A, right, read with 50 CA. we have to go through that and we have to ascertain or allocate values to determine what is the floor price. Now, if there is going to be this sort of a loop holding and the structure is very complex, it becomes very difficult for us to justify, right? We don't know how the tax authorities are going to see it. We don't know what's going to be understood out of it. So it makes sense to break out all of come out of all of these things and have a more simplified corporate structure. Also with various other compliances today, right? A lot of times these entities were formed, especially in the 70s, 80s, 90s, to claim certain benefits, right? Let's say there could have been sales tax benefits, or there could have been some whatever industrial estate, whatever each state did some promotions. So to claim those benefits, they might have had some conditions and things like that. There are a lot of entities like that which were also formed. Now, you can break all those structures because post GST or post whatever changes are there, they are not relevant anymore to the corporate structure. So those are also reasons why we could look at changing it. Right. So this is just a general introduction. Now let me just get to a specific thing on what was the merger we had to do. Now this is a group which is headquartered in Kottayam, Kerala. They came to us to try and merge. They have totally around 25 companies. The group we had to merge certain number of companies because they wanted to make life easier for themselves in terms of compliance. There's a lot of companies were just holding assets and did not have any running businesses as such, or rather they were just collecting rent or let properties out to sister concerns, etc. But a very complex corporate structure was created, which I will show you. Right. One of the key factors here was that all the companies ultimately were controlled by the same family of individuals. Right. There were about 6 people, and they controlled the entire group. Right. So this is the background, and this is pretty common, right? This is how it is in most cases, and they wanted to combine the various entities. So let me just show you the diagram. I mean, this is in Word because I'm not able to. One second. So I've blanked out the names in the diagram because there are other entities also here. Okay, can you see this? So this is the corporate structure, right? And it took me a day to draw this. I mean, about half a day to draw this diagram. So, any idea how to value all these companies? Like, how do you value this group of companies to arrive at a value? So, this is you can see the lines going all over the place. You can see that each company has multiple lines to and fro from it. This was the real challenge for me to unravel. So very happily, client got on a call. We discussed, yes, we'll have to do a merger. They said there might be some issues. But anyway, we want to have so many companies merged. I mean, originally it was supposed to be 3 different transactions and not a single transaction. So the companies in green were supposed to be merged. The companies in orange were supposed to be merged, and the companies in blue were supposed to be merged. It was supposed to be 3 mergers. And then there were when we studied the diagram, we felt D and E had to also be brought into the transactions. That's why it's in gray. The companies in white are all companies which we need not, which are held by the group, which were shareholders in these companies, but need not be brought into the merger. Right. So this was the structure which we had. Now, when I said, okay, 3 mergers. So, okay, this is probably what I'm going to charge you. This is the work which is going to be involved. Then they sent me the data, and then I was like, sorry, we need to talk everything. We need to start over. This is not going to work. I don't think this is a open and shut vanilla case. I'm dealing with something which is more complex, right? So this is, I mean, how do you resolve this, right? Any first impressions? Because whenever I show this, I want to understand what people think looking at it in terms of.
Actually, Mr. Vishesh, I would like to stop you here for 1 second. I request
Okay.
participants, many senior practicing professionals might have faced this situation. So
Right.
please share with us your experience now so that, each one of us are benefited from your experience. This is really
Right.
For me, of course, it's very shocking to see this. But any one of you have actually handled it, please share your experience.
Good morning, Naveen here.
Mr. Naveen, good morning.
Good morning. I shared one situation where there were 30 companies involved, but I'm very cautious. Before I take up the assignment, I first ask, in case of all these valuations, that how many companies are involved. Go to the, various levels, check how many companies are involved, cross-holdings. Cross-holding, it creates a little bit issue, but it's not that big a issue. It can be solved. Few people do get bogged down because of the cross holdings. But normally, if you what we call binomial equation, you put the numbers and start solving one by one. One is able to solve.
Yes.
Okay.
Yes.
However, one should know the scope of work, that how many companies are involved when you handle any valuation. And that's true whether it's merger and acquisition or even pure vanilla valuations, which we do on day-to-day basis.
Right. Agreed, sir. So in this case, unfortunately, we can't use binomial or quadratic because all the companies are linked to each other. If you see, except the ones in white, all the other companies are linked to each other. So
these are
my so my first impression was to try and use a binomial. To try and construct this into equations. So there are a lot of workings where I have tried to make all of these, sort of put them in an order, rearrange the equations in an order, in multiple orders to try and, sort of get A in terms of A expressed in terms of X, Y, Z and whatever B and C, etc. And I sort of tried to do that process. Sir is absolutely right. First step is always to look at it mathematically to see if we can use basic algebra or quadratic equation or something to resolve the issue, right? But the difficulty became that I kept plotting and then I had something like 100 plus equation, 100, 120. I hit 100 equations and then I stopped because whichever way, because I tried writing equation in different ways and then I had about 100 different ways of looking at it and just felt it is too difficult to do. I identified companies which could be eliminated, etc. We were looking at those options also, but it ultimately did not serve the purpose. What I also suggested initially was we allow cross holdings between the three companies which are merged, but we will merge companies in a different manner. But the client was very clear that it did not serve their end corporate purpose because the companies I was trying to merge were all in different parts. When the companies which they have suggested in this scheme were all in allied businesses or were next to each other or things like that, right? So it had to be in a logical manner, and whatever, just because let's say A, G, and H makes sense to merge A, G, and H. It was easy to do. I couldn't tell them that okay, they said it doesn't make sense. Okay, I can merge A, G, H, and H, but it doesn't solve a single problem for me because it's still the same thing, right? So agreed. So one was a quadratic equation or a equation. Any other thoughts on what could be done?
Okay. The best thing would be to start from group consolidated accounts, like what is the internal structure for reporting and preparation of accounts?
They are all, so none of the investments meet even the associate threshold, sir.
Okay.
All
Not
the
even
investments,
20%.
that is not even 20%. So even if let's say two companies are holding, say J and K, for example, are holding in B, it will be 5% or something like that. So each of them will hold 5% or 10%. It will not, and then there'll be other companies and individuals holding the other shares. But all of it was within the group. So I had to, again, my initial impression was let's try and identify associates, subsidiaries, let's take CFS and let's start working with CFS. But no CFS were done. Everything is a standalone company.
Maithili, you wanted to share something? Go
Yeah.
ahead.
Would it make sense to pick up all the ones wherever there is substantial holding and roll it into the main valuation and ignore where there is a minority holding in terms of value? Would that make sense?
Can you explain a bit more? Sorry, I didn't.
No, I'm just saying that just like how you do an associate and a subsidiary, identify only the associates and subsidiary because there you can actually influence policy decisions and try to ascertain the value and see whether it fits into a quadratic equation. That's what I would have done. And wherever there is minority holding and just for the sake of holding, you sort of take it at book value because it doesn't actually impact in a big way.
Right. Yes. So all the companies, the shareholders in all the companies are family members or companies in which again the same family members are shareholders. So, but again, as I told you, none of them actually met the threshold of associate or holding company. And you're right. I also tried to do the same quadratic. I went through the same process, right? It is good because we are all thinking on the same ways, right? When we are encountering the problem, we are all thinking on the same manner. And yes, ultimately the valuation was done using book values only because both as we can go under pooling of interest method and we can go under AS 14, we can go under pooling of interest method, and under Ind AS 103, because there is common control, ultimately there is common control, we can go under pooling of interest method. So whichever, whether Ind AS or ICAI accounting standards, we can go for pooling of interest method. That is valid.
So just to share, my view is that first to identify how many valuation reports are required between a transferring company and other company. And second thing is identify where is a significant amount investment. If a small investments, I think I may not look at it. Where are the values are more. This is too complex. So here I don't have a solution, but wherever done, it is small companies. We had only 3 companies cross holding. We could manage. That's the issue.
Yes, sir. So the thing is, we couldn't ignore any investments because these companies also had outside investments, which obviously we took at whatever is the investment value, etc. Other related companies and things like that. But okay, so any other impressions? Anything else? Anybody has any other suggestions and idea? Okay, so great. I think glad that we are all thinking on the same lines, right? So I was in the same position where there was silence and I was wondering what to do because I was breaking my head over for many days. I was writing down, and this was during the pandemic, so it was good because I was a bit free and I had the time to do this. But I was sitting at night and I was writing these equations, trying to resolve it because whatever solutions I came out with, they shorted down saying that in terms of rearranging the companies, in terms of doing all of those things, right? So can we do this transfer? Can we do that? And all of this, it didn't work for them. So I had to come out with a solution where we could try and uh, resolve the entire corporate structure in a single shot, right? And they had concerns over, they also had to look at whether any land sealing issues will come, whether suddenly the number of employees would exceed a certain limit, which would cause certain issues. All of these things were also their concerns. So I couldn't just like that rearrange companies looking at all those practical considerations also, right? So I'll just quickly go back to the PPT and also tell you what are the other things we evaluate. Right. So none of the companies, as I told you, had a holding subsidiary or an associate relationship between them. They were all deliberate. This was deliberately done because of, as I told you, there are certain legacy issues in the country. So for certain legacy issues and claiming certain things, they had done this scheme, right? They had sort of run the company like this, right? It was all legal. It was all done for legitimate purposes. Nothing illegal. Nothing background. That was something which I first had to verify and ensure for my own comfort, right? That I was not in trying to help someone do something wrong, right? But apart from that, you know, there there were 2 other companies apart from you saw in the diagram which were in gray. Those 2 companies had 10 and 15 companies as shareholders in them. So we had to first eliminate them because if they are coming in, then it is going to be even bigger mess because they had sizable businesses and they had a lot of other shareholders also. So we felt that there were we had to figure out a way. We were ready to bring them in, but the promoters were not keen on bringing those companies into the merger, my original suggestion was you bring those companies also. Let's bring in all the companies because we are going to have to resolve it. Once we have hit on a solution, I felt that let's use the solution and resolve all of them at one shot, right? Like why we know how, once we have figured out how, what is the way out, let's take the full way out instead of trying to break things down. But for their legitimate concerns and reasons, they felt we should not do that. They wanted to keep those two companies out, right? So I will tell you what are the other options we considered and how we reduce the companies also, right? So those two companies were eliminated by doing, we could do some buybacks. We studied it, and there were a couple of small buybacks we did. Very small shares, small amount of shares were bought back, and after those very small amounts of buyback, we were able to remove those companies and bring it down only to 13 companies, right? And we tried. So one of the things was transferring shares to other people. It was very difficult because of capital gains had to be paid and minimum value to be considered. Considering the floor price under 50 CA, it was not possible to resolve the loops because we can't. We don't want to show this or say that, listen, we had something very complex, but we are now doing transferring shares to simplify. Then how do you pay tax? Like how do you justify the value to the taxation authorities? So to do that, we didn't want to try and risk it. So as I told you, the entire exercise was also to now resolve and make life easier tomorrow going forward in terms of all compliances. Now, another thing, we were able to do the small buybacks, but we could not do big buybacks. So the thing is not just to try and immediately try and merge all the companies. We also studied how to first simplify and realign the companies before going for a merger. So either through share transfers or through buybacks or through small companies merger through the regional director. We wanted to try and do all of these things to make life easier for the client, right? Because ultimately doing something large scale also involves a lot of cost, right? In multiple ways. So we wanted to avoid all of that. We couldn't do buybacks because the holding limits in the companies of whatever change we had to break were more than, almost in all the cases were more than were allowed under the Companies Act, except for those two cases. Again, the companies did not meet the definition of small companies because of the assets they had, right? Legacy issues where all the companies had been operating companies and they had built up assets over a period of a few years. So we couldn't go for a RD-based merger, small companies merger, like remove a few, try and make life easier and go for an RD merger. That also did not happen. So we had to necessarily go through NCLT. So my solution was very simple. What I did was, let me just go back to the diagram. So what I did was all the companies in green, orange, and blue, after having gone through their corporate structure fully and understanding, I decided to treat all of them as a single pool of assets, ultimately controlled by a group of people, right? So instead of trying to eliminate and break and do everything, it's pretty much saying that, what ultimately a group of people are controlling a certain asset, right? Or a group of assets and liabilities, which happen to be different companies, right? Together, right? And there is enough and more proof to show that they are acting together. We also got, I'll come to the documentation part separately, but there is enough and more proof to show that they are all acting together in controlling and taking decisions on the operations of all of these companies. There is enough and more common control, and there is ultimately no minority at all other than these people, right? In fact, there was zero minority other than these 6 people involved, right? Directly or indirectly, it was only them and nobody else who was involved, right? So I think it was 6 or 8. I don't. It was depending on the companies, but it was ultimately these people who were involved, right? So based on this, we are finally, I treated all of them as a single pool of assets, and once I changed my perspective, like how we were all trying to solve mathematical equations, I decided let me not solve the equations. Let me just look at this as a single pool of assets, right? That the entire thing is one big khichdi which is there, and now I just need to look at, okay, what is this khichdi? What is the net worth of the khichdi? Then we have to then get down to the assigning, and obviously we have to do the swap ratios, etc. So what I did was looking at this entire pool. One cannot owe oneself, one cannot invest in oneself. So I eliminated all those transactions on both the sides. Basically, the capital amount invested, the face value of the capital invested was eliminated on both sides. So then I had a overall pool value, which is after excluding all these cross holdings, etc. I had a clear idea of what was the actual worth of these assets, right? And then we got down to looking at identifying a company, the transferee company, and then there'll be 12 transferors. Originally, the scheme had a system where we would merge all the companies together, clean out the corporate structure, and then demerge them into these green, orange, and blue, which is why they are marked in that. But the promoters decided in the end that we will drop the demerger plan because anyway, it serves their purpose just to have a single company. If required, we'll demerge it later, but right now we don't require it. But the original scheme involved a demerger also apart from a merger, right? So the idea here was very simple. We will treat the entire group of assets as a single pool of assets. And this eliminated, what this does immediately is that it removes all that complex corporate structure. On the liability side, as in the capital side, it only leaves the people who are not part of the merger as balance. So this was individuals, and there were a few companies which were there, which were not related to the merger, right? Where which did not get into this whole loops and hoops and all these issues with the merger. So we kept those companies, but those companies were also in turn ultimately controlled only by the same group of individuals, and there were no other minority or outsiders at all, right? So we had so how to, now I had the solution in terms of what had to be done, but we cannot just give a solution saying, oh, this sounds nice. So what I did was I looked at what AS21 says in terms of consolidation, which I think is what we were all ultimately getting to. How do we make all of them associates, or how do we make all of them holding subsidiary? How do we look at a consolidated financial statements is what we wanted to do. So let's forget the individual companies and what is happening over there, that none of them are subsidiaries or associates, but ultimately all of them are controlled by the same individuals. So by virtue of control, we can look at all of them as companies which can be consolidated. So using the principles of AS21, going for a line by line consolidation and eliminating all the cross holdings, right? The mutual holdings in all the companies, I arrived at the value of the companies. Now that is easy. But then the next step question was, how are you going to issue shares to the individuals? Because the shareholding percentage was different in each company. In some companies, certain people did not have any holdings because of the time in which the companies were created. Some people might not have even been born. I'm not sure about that, but I think they could have been companies in which people were not born, or they were minors or something like that. So how do you allocate values to the different companies? What I did was I looked at a methodology of using assets as weights. So the assets held by the companies were treated as weights to be given to the entire pool of valuation. Based on that weightage, and then considering the existing holding, sort of allocated within the pool of assets values to, let's say, A, B, C, D, E, F, G, H, I, J, K. And then from there, we looked at the holding percentage of each individual in each of those individual companies, and using those weights arrived at an ultimate holding. And what happened was, the entire thing was done using pooling of interest, and the values values taken were book values, because common control, no change in values, there are no outside interests, so no need for fair value. It was done using a book value based merger. Now,
assets were valued at book value.
Yeah, everything was done at book value. There's no need for any fair valuation, because the entire thing is common control. When there is common control and there is no public issue, there is no need to go for any other valuation. Everything can be done at book value. So we then we had to do a reconciliation to ensure that there was no value loss, right? Because ultimately I'm doing a lot of ratios. There were 2-3 levels of ratios and percentages being used. So then we reconciled to see that there is no loss. And in the end, what we arrived at is a percentage of holding, which sort of reflected, ultimately the control of the different individuals in the ultimate pool of assets. You can see that all of those things are actually given in the scheme document. You can go through it. You'll be able to see, in the order, you will be able to see some of those things in the order, right? So this was the methodology which was followed. Any questions on what do I say? Asset weighted shareholding is that we looked at it or based on the net asset ownership of the assets in each of the companies, right? And the concept of that you cannot owe or invest in oneself. Based on that, I eliminated all the mutual holdings and cross holdings, and then chose a company which had a sizable amount of assets where everybody was involved, so that there is no question of trying to issue fresh shares, etc. A company which we Rule 11A calls for FM. So, Rule 11A does not come for when there is a merger. Merger is an exempt transaction under income tax, which is why we even went for a merger in the first place. Yes.
Valuation is done on the book value method, not fair value. DCF method
Yes,
is
sir.
not done.
Not required, sir. So DCF is whenever we are looking at where there is a common control, then unless there is going to be an adverse impact on minority, then there is no need for a fair valuation. You can go under book value, right? Even the accounting standards allow us to do the accounting under book value.
Minority
Common control
was not
common
there.
control means all 100% shareholders of the transferor company become transferee or 90%. Because there, how do you
100%. So, common control means that all the let's say A, B, C, D are there, right? All the A, B, C, D companies are ultimately held by the same people. In whichever scenario we are talking about, all the companies in the merger are controlled by the same people, right? So this is usually the case in a lot of family concerns and closely held groups. There might be a very small minority where there is common control, meaning that let's say A controls B and C. I'm merging B and C. A remains separate, but I'm merging only B and C. Then B and C merger can be done under common control, under book value, subject to there being no other valuation interest issue. Like say there is a minority who has to be removed from the transaction. Recently, I've done that also, where for a concern, we did the merger at book value, but the minority was bought out at fair value. Right? Because first step, we had to buy out the minority. For the minority, we arrived at a fair value and offered them a fair value to exit one of the companies. But ultimately, the merger was done using book value because the assets are controlled only by a few individuals.
And this order is already passed, no, by NCLT. Like
yes.
many other
Yes.
professionals were raising doubts. So I thought of mentioning that this is a clear case. NCLT has already passed the order and this is a completed case.
Yes, accounting standard wise, sir, AS 14 allows pooling of interest where everything has to be recorded, assets and liabilities have to be recorded at their book value, and consideration has to be only in shares, right? And majority of the shareholders become shareholders in the transferee company also, right? In the amalgamated company also, and only fractional shares can be paid by cash. As far as Ind AS is concerned, Ind AS says only the acquisition method is allowed, except when there is common control. So Appendix 2 of Ind AS 103 allows pooling of interest method when there is common control. And this is a very pertinent thing because in the scheme, we have to mention how the accounting is also going to be done. So unless you can show how the accounting is going to be done, we cannot, the scheme will not go through. So it is necessary to show how the accounting can also be done.
Vishesh, I have a question.
Yes.
So related to, hello, am I audible?
Sorry, your voice is not clear.
Yes. Is it audible now?
Yes.
Yeah, so related to this, your second point, the number of shares and investment in company adjusted to eliminate the shares held by other companies. So what does that mean? Can you just explain that?
So basically, each company in the pool holds in other companies, right? So because of the loop holding and cross holding, so there was cross and loops happening at the same time. So what you can't owe once. So now when I'm treating this as a single pool of assets, let's say company A is holding in B, B is holding in C, C is holding in A again. Then I eliminate this common shareholding. Say A is holding 10 shares in B, B is holding 10 shares in C, C is holding 10 shares in A. Then I have to eliminate this value across the board on both the liability side as well as the asset side.
Then if there is some holdco in the group which is holding almost a stake in each and every company, then and that holdco is not holding any other asset except that investment, then you would not allocate any value to the holdco, because if you eliminate those shares value in the net asset, then the holdco would have no value at all.
Correct, because the holding company's value would be entirely from the other assets. Now it has no value of its own.
So by that logic, in the merger, the holdco would not be allotted any shares.
There was no holding company here. That was actually the problem. If there had been a holding company, my life would have been easier. There is no holding or associate or anything. Every company had a separate line of business and had its own business,
No. So
had its own
basically,
operations.
group holdco means that there is some investment company which is holding
Correct.
10% stake in
Yes.
each and every company.
Correct.
Then
Correct.
that
Exactly.
company, as per this logic and formula, that company would not be allocated any shares, right? Because they are not owning any other assets.
Correct. If this methodology is going to be assigned to such a case, then yes. But again, I can't say whether we can use this methodology for those cases without studying it. Right. So in this case, I could use this methodology because it worked and it made sense. But if there is a group holding company, then probably I'll adopt a different methodology based on those circumstances.
Okay. Okay.
Mr. Vishesh, one small doubt. Mr. Gaurav, we will give you also the chance. Did your valuation report contain the information of the individual shareholders, or that was just a calculation which was given to the
It
company?
contained all the information.
So you also went ahead and gave the post-issue, like post-merger shareholding pattern.
Yes, it is part of the order. In fact, I can share the
Order
order.
itself said post-merger shareholding pattern. Normally, our valuation report has only swap ratios, right?
Yeah, these are the swap ratios. So let me check if it had. But yeah, I have calculated and given them the post-merger shareholding also. In fact, I told you, right, I had to calculate, not able to locate it right now, but basically I had calculated what is the share capital to be eliminated also. Because what happens is, you have to cancel the share capital has to be consolidated into the transferee company, and fresh shares have to be issued. All the old shares, mutually held shares, have to be cancelled, and fresh shares have to be issued to the shareholders in their particular ratio to ensure the correct ratio comes. So I had given that calculation also to the secretarial team to add it in their report in the scheme, so that ultimately the scheme will have that holding.
But Shilpa, it is not mandatory to give that post-shareholding pattern in the valuation report. It is apart. We have to give only swap ratio as a valuer.
Correct. We have to only get the swap ratio. In this case, because I was doing the full advisory, I went ahead and I did all the calculations and gave them so that it's easy for them to execute the transaction.
Sir, can I ask a question now?
Yeah. Yes.
Yes. Sir, I have a this is with respect to valuing shares at the book value of the there's a common control. So I have a case where there are two families. Okay. Both families are relative to each other's. Okay, and they are individually holding shares in 4, 5, 6 companies.
Okay.
And their percentage is not same. Some might hold a higher number of shares and some might hold lower number of shares. And now they are proposing to merge these companies.
Okay.
In the scheme, they have stated that the amalgamating companies shareholders will be issued preference shares or equity shares as per the ratio, and purely on book value only, not calculating fair value. So is that okay, or should we arrive at the fair value of individual companies in this case?
I have to go through the details. I can't just say offhand, but both methods are allowed. It depends on what is the circumstances, right? It is based on the premise and circumstances. Usually, as a thumb rule, see, whenever we are seeing at a book value, there should be, if there is going to be any alteration in terms of gain or loss, ultimately between family members, and they are all right. If there is going to be minor changes, it is fine. But tomorrow, if you're going to have any minority or any one family member fighting it out and saying, no, I'm losing because of this merger, then you will have to go for fair values to show that there is no loss or this is the actual value to do. So we have to go through the details of the transactions.
But is the thing that as of now, the merger, we don't know that, post merger, if any individual might raise the questions about the swap ratios. So
you need to So you need to take a consent affidavit, or that's why what in this case we did was, in terms of documentation, right? We got for my sake, I got an MRN, but we also executed a document to ensure that we got an undertaking from them that they'll all act together as a group of individuals doing the same thing, right?
Acha.
So that tomorrow there is no issue in terms of documentation. We should not have that issue. Exactly what you're saying. We don't know what they are going to do tomorrow, but I'm making an assumption that they will do something today. I can't stop them from doing something different tomorrow. But for me to know my assumption is correct, I need a documentation, which is why I took an MRN from them in all the companies saying that they will act together and this is how they intend to control the business.
Okay, great, sir. Thank you so much.
Vishesh, I had a question. Hello.
Yes, yes.
So when there is this kind of merger, or when any 2 or 3 group companies are getting merged, but some company have issued like CCPs or OCDs or CCDs, then what is the kind of the adjustment we have to make at the time of the arriving at the valuation and swap ratios?
So one, we general thumb rule is we always look at everything on a fully diluted basis. Just give me a second. Sorry, yeah. So we were talking about CCDs and OCDs, etc. General rule is to look at a fully diluted basis, but also depends on the transaction. There are cases where if they are, you're talking about case where they are holding CCDs and OCDs in each other or in or with third parties.
In each other.
In each other, then we have to eliminate it. We can look at a case of before going into the merger itself, we can look at converting the CCDs. If there is no tax impact, then we can look at converting the CCDs and then eliminating the share capital also. So it depends on case to case basis how we sequence the transaction.
Okay, so basically when you eliminate the shares in the net asset, okay, for example,
Yes,
in net asset you are eliminating, then while arriving at the total number of the company, at that point of time also you eliminate the shares?
yes. As in you're asking in this particular case, right?
No, so for example, there is a company B in which A and C are holding the shares. Okay, so while arriving at the value of A and C, you eliminate the shares of B, right? Which is held as an investment in the
Correct. If all three are being merged, yes. If all three are being merged, then yes, yeah.
Okay, then for the B company shares, while arriving at the swap ratio, would you consider the total number of shares issued by B, or at that point of time also you will eliminate the A and C shares?
I have to eliminate A and C also.
Okay, okay.
Yes, both basically we are reversing the capital entry.
Got it.
On both sides, yes, yes.
Mr. Vishesh, actually, I was thinking if we could pause the recording and then you can share your experience. We can take the questions later. Yeah.
Yeah, sure.
Vijaya, can you pause the recording? Vijaya?
We did a lot of work in that case. So yeah, maybe we can have one more session on a couple of other things, which something else also later on. But yes.
Yes. Thanks, Mr. Vishesh, for a wonderful session.
Thank you, ma'am.
Before we conclude the session, I presume all the doubts are cleared on this topic. I request Kusum on behalf of Bangalore Value Association to convey formally vote of thanks to the speaker.
Very good morning, Shilpa and all the members, all the participants who are participating this morning. And I must tell you that we have had a very, very interesting session this morning. And Mr. Vishesh, he comes, he's a very young professional, but he actually comes with a great amount of experience. And it only goes on to say how much of effort that he has actually put in kind of, trying to simplify the case. While it actually looked very complex, considering the holding structure and considering, the shareholding pattern, and also taking into account that there was no, holding, and there was only cross holdings with no real associate company as such. So in taking into consideration all these things, how he has, simplified a complex structure is very, very commendable. And again, he's a very young professional, having, various certifications to his credit, and that again is very, very laudable. So, Mr. Vishesh, we are very, very thankful to you this morning for having shared your experience, and we are also very thankful for having shared, the reference to the case, so that we also can actually go through. All of us are professionals here, all of us are valuers here, so we can bank upon each other's experience and make it very, very valuable for the client. Thank you once again for being a part of BVA, and we look forward to hearing much more of you. We also thank all the participants this morning who have made sure that they have participated on a Saturday morning. Thanks to the participants as well, and of course many thanks to the committee members of BVA for having got some excellent speakers to share their experience. Thank you once again. Over to you, Shilpa.
Thank you, Suggestive. Thank you, everyone. Glad to have participated today morning. Nice to see. I'm actually quite. Usually, most of the forum we have not today any CP events or anything. Usually, only very few people join. It's usually 10-15 people who join. Today, I think at some point I saw some 40+ people. I'm quite surprised by the response. Thank you for having me. It's a pleasure to share all the information today morning. I hope it will be useful for everyone. Thank you for having me.
Subara, would you like to share something?
Yes. Thank you, Vishesh, once again. And even I request all BVA members, okay, like we have to show some difference between other valuers and our BVA members at least, okay. Being all professionals, we can go ahead with one more step and we can discuss with management whenever we are doing valuation. It is not just like number game what we are going to do. And we can give some extra, the mileage or to give extra process to them. And it will be very beneficial, okay, and also as a valuer will get more mileage.
Correct, agreed. On behalf of Bangalore Valuers Association, a small token of gratitude for today's speaker. Sir, this memento will be couriered to you. Our admin will be in touch with you to take the address. Okay, thank you so much. Thanks everyone.
Thank you.
Thank you,
everyone. Thank you.
Have a long weekend. Nice weekend.
Have a nice weekend.
Thank you very much.
Vijay, you can stop the recording.